So there's one more um, topic I want to discuss in regards to the all-in-one is really the value of liquidity. In your opinion and experience working with folks that have had this product, where do you see liquidity being a major benefit and help for someone's finances in comparison to someone with a 30-year mortgage making extra payments and not having that liquidity use, that reuse of funds where they used it once to pay down the home, but then can tap into it again to cover something, right? If need
Exactly.
be. And so in that example, you don't have liquidity, but with the all-in-one, you have the benefit of paying this down faster, more efficiently, and it being liquid. Where do you see some really cool
So
cases?
there's
Or
kind of a few major ones that come to top of mind. One, a major expense coming up. You have a doctor bill, or you have some sort of major one-time expense that, gosh, if I didn't apply that $1,000 every single month for the last few years, I probably could have afforded this. And now I have this major medical debt looming over me, or I didn't even know that there was this collection item or what have you. It gives you the ability of, I have this safety net behind me that I can use as a cushion. Now, I can't speak in turn. Another instance would be kind of some sort of investing. Now, I can't speak in terms of all forms of investing. Personally, I have put, focused on real estate because that's what I know. And it gives you a little more flexibility. So, for example, there was a property that I was looking over on the East Coast. And because I'd built up enough equity in my all in one, it was something like a $60,000 purchase of a property that we then needed to renovate the property. And so it was, hey, we're going to make a cash offer less than what you guys were requesting the home to be sold for. And we were able to get the property for slightly less than what they were selling the property for. And simultaneously, I was then able to get all the renovations done without going through some sort of financing route. And then
mm,
once that was all completed, put a rent tenant in the property, refied, pull the cash out, and paid the line of credit off. So now I'm essentially, minimal dollars into the transaction while still receiving monthly cash flow from the property. So I can do that again and again. And as long as you're making smart mathematical business decisions, um, if it costs you 5 grand every transaction and you have the wiggle room to do it, that's fine. Because if you're renting out the property for $300 more than what your rental payment is, or what your mortgage payment is on it, then that money will start to pay itself back over time relatively fast. So you will make your money back. And that's kind of how I look at it.
nice. What's another? Because you say you had three come to mind. What's another uh, value of liquidity scenario here with the
Yeah. So,
product?
one of the major values of liquidity is, um, realistically, I would say that I am meeting more people now that are kind of going past retirement age and still working, not because they really want to, but because they have to. And if you have 10 or 15 years before, or 9 or 5 years before you were wanting to retire, and then something happens, you're kind of securing your future self so that you don't need to work into your mid to late 70s if that is something you didn't want to do. And it gives you the ability to say, hey, we paid our home off, we're receiving this monthly fixed income. Um, and instead of spending half of it towards our mortgage payment, that's another half that we can spend on our grandkids, or that's another half that we can potentially even start working on an early inheritance to our kids that isn't just going to be something we see them that they do, once we're gone, but it's something we get to watch with them and be involved with them and actually see their lives drastically change. So, kind of three ends of the spectrum there, but I think that that's a potential value add, in my opinion, giving people the
Yeah.
ability to retire when they want to retire, when they are just can't retire. I mean, there's a lot of unique things happening in the economy that.
Right. Another one that I have actually witnessed certain clients go through is job loss, right?
Mhm.
Or they have an injury. Can you speak to how the all-in-one, if someone loses their job and they have a significant amount of equity built up in the line of credit, what are some cool features where it's like, if I'm not able to make a payment, what happens? If I lost
Yeah.
my job, not even making a payment, but I have equity, I have replaced my sinking funds. There's a lot of people that use sinking funds, that use emergency funds, a separate savings account, separate checking account to cover certain expenses, or to help cover unexpected expenses. And because they now have the all-in-one, they've replaced those accounts, they've moved those dollars and put it into the credit line and just parked it there. In that case, can you speak to, like, okay, I lost my job, not able to no longer automatically dump funds in here. Now
Yeah.
the money's just going to be coming out. How do I also cover that bill?
So you said something, and it's almost, it's really is semantics, but you said they're not able to make their payment. So if they have available line of credit, their payment just comes from their line of credit. In fact, in this product, you never actually physically make your own payment. It's automatically withdrawn from what you have available. I believe that really what you're saying is they aren't able to make a deposit into their account because their payments are going to be made. So if they have $100,000 of available equity and they lost their job, great that they're in an all-in-one because they have that 100 grand of buffer. They can still make their car payment if they happen to have a car payment. They can still pay their credit card bills. Their mortgage is going to be made because it's all going to be coming out of that line of credit. Now, yes, they may be going backwards and they may be increasing their balance, but it's helping them get through that 5, 6, 8, 12-month time frame, depending on how much equity they have and what their spending is. Usually people's spending goes down when they lose their jobs. So you would expect some of that to come down a little bit. But it gives them that buffer to say, okay, I really need to get back on my feet. I need to find the right thing. Okay, it's a little more difficult for me to find a job. I'm still pushing and I'm trying. And it still helps them get through it without them having this 500 credit score on the back end of it or any type of foreclosure or repossession or anything along those lines.
Yep. Perfect example for those of you listening. I've had a client that had the all-in-one. They, uh, I don't want to say they got fired from their job, but they quit and then got a severance package, right? So I think it was like over 50 grand. So they had a lump sum of money and they were already accelerating the pay down of their all-in-one. They were dumping income in, expenses out. There was more going in than coming out. So they had a significant amount of equity built up in the line. I'd say they paid off at least a good 30% from when they initially started off. Then they had that 50 plus $1,000 severance package, lump sum of cash. And instead of, in the traditional sense, having a 30-year mortgage, all that money that 30% or so, they would have thrown at their mortgage, they would not have access to that, and they would have only had that 50K severance package, right? And that would have only taken them so far, right? Maybe 6 months, right? Maybe 8 months, whatever it is. Let's say 6 to 8 months. In this case, because they have the all-in-one, they actually made the conscious decision, instead of trying to find another job replacement quickly, they actually decided to go on a sabbatical for about 1 year, and they decided that I'm going to look into entrepreneurship. I'm going to look into doing my own thing and really give myself that framework. I'm going to invest in myself. So they had the 50K, they had all that equity available in their all-in-one, and they dumped the 50,000 into the line of credit. So that dramatically reduced their interest costs, right?
Mm-hmm.
And wife was still working, I believe. So she wasn't making maybe a few thousand a month, but basically that was like covering the interest
Yeah.
for the most part on the all-in-one, plus maybe some additional um, cash flow. But the fact that they were able to say, you know what, looking at the math here, I have the ability of taking a year off from work to really discover myself, find my purpose, look into a different opportunity, really observe things, and they still had an additional year of cash reserves before the line of credit would get to a certain dollar amount where they would start to feel, let's say uncomfortable, like I don't want to, owe that much on
Yeah.
on the line. But we're talking about, being able to give yourself an extra year here, an extra 6 months. That could be tremendous in terms of opportunities, being able to actually sit, look at opportunities on the table, and make a decision rather than, oh my goodness, I need to go right back to work because I lost my job and I'm stressed out, and that can be pretty hectic. So that's just a cool example there where you're not required to come up with money to make a payment
Yeah.
because it's being taken from the equity available in the line. In a 30-year traditional mortgage, it doesn't matter how much extra you've paid toward it, you still have to make that normal mortgage payment each and every month, and there's no flexibility, right? And if you need to access that money in the event you lose your job, you need to borrow. Most Americans have no idea how to borrow efficiently. Having an
No.
all-in-one loan product is another safety feature, another function of use in terms of helping the borrower be a more efficient borrower. On average, from what I've seen and witnessed, most Americans, when they need money right away, they will exhaust and max out credit cards, which is the highest form of interest, right? Then what they do, right? And let's just say they had some emergency fund, some sort of cash liquid. They burn through that. Then they start to hit their credit cards. Those start to max out. The reason why they started there is maybe they had a 0% card here, balance transfer here for 0%. They thought things were going to get better. It didn't. The 0% expired. The 0% period expired. They're now getting hit, right? And they've pretty much maxed out their credit cards. But then the next thing they do is they get a loan, right? They'll either get a loan from their mortgage, a second loan, a home equity loan, not a line of credit, because they don't know those exist, right? They don't get promoted often from the banks. They get the loan or they get a personal loan, and now they're locked in to another payment, fixed, no flexibility, but they have this lump sum of cash. And they use that lump sum to maybe consolidate some other debts, maybe to help pay for debts. And you can just see the massive pile of debt that they start to build on themselves, not realizing that there was a far more efficient way of doing that with a line of credit, only taking what you need little by little, month by month, day by day even, at a time to recover, right? And when you actually look at and compare, often the person with a line of credit, yes, they increased their debt just like the other person did, but at a far less interest cost and a far less total balance owed than the person with no flexibility that had to tap into things, use collateral, leverage, put things up, put their credit at risk essentially to get things, and still to really fail in the end because the problem didn't get solved. They just created a bigger debt, right,
Oh,
overall. So the value of liquidity is tremendous in the timeline, in the process, in the journey of, let's say, becoming debt free. Again, a lot of people use Excel spreadsheets. They'll use these calculators and it'll say you'll be debt free, making extra payments this month, and by 9 years, 10 years. But what the spreadsheet doesn't factor in is life circumstances, unexpected events, moments where you need high liquidity and it's not there. That adds a much longer timeline than if you would have had a line of credit. So being able to like understand the difference between interest rate, interest costs, value of liquidity, safety, all these other features that come into play, I think is really going to help the individual make a decision whether I should replace my first lien mortgage with this all-in-one, or use the all-in-one to buy a property, right?